ABSLI Wealth Aspire Plan. Will investing in this policy help you achieve wealth creation in the long run? Let us find out through an in-depth analysis of this policy in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decisions to reach your financial goal in a more faster and smarter way. Before analyzing whether investing in this policy will be a good fit for your future or not, let us first understand a few basic details about this policy and how it briefly works. So, ABSLI Wealth Aspire Plan is a unit-linked life insurance policy. So, some of the key features of this policy is that you have the option to select from two plan variants which is tailored to your aspirations. They also have a choice of various policy terms to fit your needs, and you also have a wide range of selection of multiple premium payment terms for your convenience, and there is the availability of 4 investment options to match your investment goals, and you also have the ability to add top-ups whenever you have extra savings. There is facility for partial withdrawals as well to address emergency fund requirements. So these are some of the key features of this policy. Now let's take a look at the benefits available under this policy. So first is a death benefit, which is given to the nominee in case of unfortunate death of the policyholder during the policy term. So if they have chosen the classic option, then the death benefit will either be the fund value on the date of intimation of death or the sum assured, whichever is the highest in value at the date of death of the policyholder. This will be given as the death benefit to the nominee or the legal heir. In case if they have chosen the assured option, then they will either get sum assured on the date of death and top up sum assured, or 105% of the annualized premiums paid excluding GST. Further, this policy will not terminate once this death benefit is paid to the nominee, and it continues till the policy maturity date. So these are the death benefit which differs among these two options. Now let's take a look at the maturity benefit. So the maturity benefit under both options is that the fund value plus the top up fund value in a lump sum will be payable to you as the maturity benefit. And they also give you guaranteed additions, which is another benefit on the 6th policy here. And if you have chosen the band 1, then it will be 11th policy here. And every policy anniversary thereafter, guaranteed addition as a percentage of the average fund value in the last 12 months will be added to your policy. On the 10th policy here and on every 5th policy anniversary thereafter, an extra guaranteed addition is added to the fund value. So these are all the benefits you can get by investing in this policy. So now let us move on to understanding the investment strategies and the fund options they offer for you to choose from. First, there are 18 fund options for you to choose from in this policy. As you can see from the screen, the fund options are the liquid plus fund, income advantage fund, assure fund, protector fund, builder fund, enhancer fund, creator fund, asset allocator fund, magnifier fund, maximizer fund, multiplier fund, super 20 fund, pure equity fund, value and momentum fund, capped nifty index fund, MNC fund, ESG fund, small cap fund, and there's also another linked discontinued policy fund. So all these funds are based on their risk profile and differentiated based on their asset allocation, which can either be the debt or to money market or equities or combined allocation as well. And you can choose whichever suits your risk profile and what as kind of allocation you want to give to your investment portfolio. Based on that, you can choose these fund options. Now under this policy, you decide how to invest your premiums in one of the 4 investment options. So first is the smart option. Your portfolio will be structured as per your maturity date and risk profile, which can either be conservative, moderate, aggressive. So your annualized premium, which is the net of your premium allocation charge, is allocated between the 2 funds, which is first the maximizer fund, which is an equity fund. Next is the income advantage fund, which is a debt fund in a predetermined proportion. So over time, this allocation is managed such that it will automatically switch from riskier assets to safer assets progressively as your policy approaches maturity. This proportion invested in the maximizer and income advantage fund can be understood in detail by referring to the policy brochure. Next is the systematic transfer option. So here your premium shall be first allocated to the liquid plus fund option, and thereafter monthly or 1/12 or weekly 1/48 of the allocated amount shall be transferred to a segregated fund of your choice. The percentage allocated to the chosen funds should be an increment of 1%, which can range from 5% to 100%, and the total allocation across all funds must be 100%. This option is available only if you have opted to pay your policy premium with an annual mode, and you can choose up to a maximum of 4 segregated funds out of the income advantage fund, enhancer fund, maximizer fund, super 20 fund, cap nifty index fund, multiplier fund, value and momentum fund, creator fund, MNC fund, ESG fund, and small cap fund. The third investment option is the return optimizer investment option. So your basic premium is invested in the maximizer fund and it will be tracked every day for any gains. Then the gain from the maximizer fund, if it reaches 10% or more of the net invested amount, that amount equal to the appreciation will be transferred to the income advantage fund. So your gains are protected from future market volatility. So this is one investment option. And finally, the fourth investment option is the self-managed option, which as a policyholder gives you the full freedom to control and switch from one segregated fund to another among the 18 segregated funds which we previously showed you on the screen. So the only requirement is that the percentage allocated to any fund be in increment of 1%, ranging from 5% to 100%. The total allocation across all funds must be 100%. So these are the fund options and the investment strategies available for you to choose from in this policy. Now, as an unit linked policy, it also comes with charges. So let us look at the various charges under this policy. So first is the premium allocation charge. So your premium allocation charge is basically levied based on your basic premium and the top up premium when received. So it depends on the policy here and the premium band you have chosen, and the fund management charge also depends upon that. So it ranges from 1% per annum to 1.35% per annum based on the fund options you choose, because this charge is basically for them to manage your funds. And next is the policy administration charge. This also depends on the policy here and the premium band you have chosen. And the mortality charge is for providing you with life cover, and it is charged based on your gender and the age which you have chosen to take this policy. And the surrender charges, which is the charge on discontinuance or surrender of this policy, will be based on the year you choose to discontinue or surrender and the premium amount and the fund value of your fund. So basically all these factors will determine your surrender charges or discontinuance charges. And there is also something called miscellaneous charges, which is 50% per request for change in investment option, premium redirection, fund switch, and partial withdrawal. So basically for all these requests, 50% per request is charged. So as you can see, there are a lots of charges, which is really significant for a market linked product, because these substantial fees will reduce the net premium invested, impacting your returns, because your premium which you are choosing to invest will be first deducted, and these substantial fees will be deducted, then only your premium will be invested in the market. So this impacts your returns as well over time. So as a result, your final proceeds, your final maturity value over the long term will be affected. So you need to consider all these factors before choosing to invest in this policy. Now, as we have understood the basic details about this policy and how it briefly works, now let's take a look at the advantages and disadvantages of this policy. So first of all, let's start with the advantages, which is one of the major advantages that riders can be added to the base policy, and unlimited partial withdrawals from the fund value are allowed at any time after you complete 5 policy years, and also provided the policy holder is at least 18 years old. And if you have chosen the self-managed investment option, then you can choose to redirect your future premiums under this option as well. Now these are the advantages. Now let's take a look at the disadvantages, which is also equally important to be understood, because it might reveal the potential risk you might be undertaking while choosing to invest in this policy. So the disadvantages are that policy loans are not permitted under this plan, and there is no liquidity available during the first 5 policy years, and the sum assured you get in this policy is also inadequate to meet any future financial goals. So these are all disadvantages you need to consider before carefully choosing to invest in this policy. So now, as we have completely understood how this policy basically works and what are its advantages, disadvantages, and benefits, and what are the investment options and strategies it provides for a policy holders, now it's time to get into the analysis part of the video, where we are going to analyze the internal rate of return of this policy, because this policy is basically a market linked investment opportunity, right? So here if it's a market linked investment opportunity, that means it definitely comes with inherent risk, because the returns you get is based on the market, will be based on the market. That's why we are going to conduct an IRR analysis, because no matter the benefits and advantages, what matters at the end of the day, why do we choose to invest in a policy? Because of the returns we get in our hand, right? So that's why we are going to analyze the IRR, which is the internal rate of return of this policy. So just for calculation purpose, let us assume a 35-year-old male purchases this policy with a sum assured of 15 lakhs. So the policy term is 15 years and the premium paying term is 10 years with an annual premium of 1.5 lakhs. He has selected the classic option. So if he consistently pays the premiums, he will receive the fund value as a maturity benefit. So let us assume for calculation purpose that the internal rate of return can be calculated at an assumed rate of 8% per annum, because this is a market linked investment, right? So for the best case scenario, let us assume the 8% part. This rate is not guaranteed return, or like it does not represent the upper or lower limit of the potential returns you might get from this policy. This is completely for calculation purpose. So as you can see in the 8% return scenario, the fund value is projected to be around 29.12 lakhs with an IRR of 6.36% as per the ABSLI Wealth Aspire Plan Maturity Calculator. So this rate of return does not seem sustainable, and nor does it seem justifiable to the risk we undertake in this policy, because it's a long-term investment and we take such a huge amount of risk, but we still get a 6.36%, which is not even matching the inflation rate. So generally, investors typically aim to generate alpha from equity investments to comfortably outpace inflation over the long term. But here it's not even matching the inflation rate. So this is basically not something a justifiable return you can see, because the potential return of this policy is comparable to that of debt instrument. But it is an equity instrument. That's why we are choosing to invest in it despite the risk, because generally equity investments typically potentially give us better returns in the long term, but here this policy fails to give us so, making it a challenge to consider this plan as an equity investment within our portfolio. So as we can see from our IRR analysis that ABSLI Wealth Aspire Plan doesn't seem to be giving the returns we desire of, or the outcome we desire. So what we are going to do is we are going to conduct another analysis, which is a comparative analysis, to see whether there is another market link product or other better products or better investment strategies available in the market where we can get better returns compared to this policy. So instead of investing in a investment cum insurance policy like ABSLI Wealth Aspire Plan, what we are going to do is we are going to explore an alternate investment strategy where we are going to separate insurance and investment and invest in it both separately. So for life cover purposes, we have chosen a pure term life insurance policy with the same metrics as ABSLI Wealth Aspire Plan, just for a fair comparison. So it also has a sum assured of 15 lakhs, which cost annual premium of 9,300 rupees. But the policy term, the premium paying term is all same as ABSLI Wealth Aspire Plan. But only the annual premium differs here, which is very less compared to the premium we paid in ABSLI Wealth Aspire Plan. So this pure term policy allows you to save 1,40,700 per year, which could then be invested in another investment vehicle. The investment vehicle we have chosen for this analysis is ELSS mutual fund, which is also a market linked product, and especially if you take a look at ELSS products, it has a track record of consistently proving that if you choose to invest in it for a long term like 7 to 10 years, it can potentially give you returns up to 12% per annum. So here if you look at it, basically this is just for your calculation purpose, but here you can customize the strategy as your risk appetite, because depending on your risk appetite you can either choose equity, which is high risk, or debt, which is a low risk investment, and choose debt instruments which can also yield you better returns than this policy. But in this scenario we have selected the ELSS fund for calculation purpose. So as you look at it, the fund value at the end of 15 years is 48.73 lakh, but these maturity proceeds are subjected to capital gains tax, which results in a post-tax value of 44.55 lakhs. So hence the post-tax IRR is 10.50%. So the IRR for the ELSS investment combined with the pure term life insurance policy is 10.50% on the post-tax return. These returns are significantly superior to those of the ABSLI Wealth Aspire Plan. They're higher than the inflation rate, thereby accelerating your wealth accumulation over the long run. So splitting the insurance and investment yields better results compared to investment in a insurance cum investment policy. So finally, what is the final verdict on our analysis on the ABSLI Wealth Aspire plan? So this plan offers a variety of fund options and investment strategies to choose from based on your personal preference. However, these options do not add any significant value because the potential returns are subpar for a long-term investment like this. The main reason for the low returns is the high charges, and also this policy has a high agent commission. So any market or related instrument should help accumulate wealth over the long term, but this plan falls short in this regard. Additionally, the sum assured is also inadequate. These two aspects makes this policy unsuitable for your investment portfolio. So what you can do instead is you can choose to invest in insurance and investment separately. So your equity investment portfolio requires higher yielding products to achieve your financial goals. Therefore, it's better to offer a pure term insurance policy for adequate life cover where you can get a higher coverage even for affordable premium, and build an investment portfolio based on your risk appetite, life goals and time horizon. So do not combine insurance and investment and invest in it separately, and so there is potential for inflation beating returns and to build wealth in the long term. But if you're still having doubt how to customize this strategy or what kind of investments will be suitable for you, you can definitely consult with a professional certified financial planner who will be able to professionally guide you through the entire investment journey process and help customize a investment portfolio for you according to your risk appetite and your financial goals, so it can be simplified and helpful for you in your financial future. If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.